How incentives quietly rewire markets. Nothing was forced. No rule demanded it. No crisis required it. Yet over time, markets began behaving differently, guided less by intention and more by incentives few people ever questioned. To understand why incentives matter more than rules, we need to look at how systems respond to reward. Markets do not move based on what is encouraged publicly, but on what is rewarded consistently. Small advantages compound. Repeated signals harden into behavior. Over time, incentives become architecture. Institutions adapted naturally. Strategies aligned with what produced reliable returns. Activities that benefited from scale, speed, and repetition expanded. Behaviors that created friction, delay, or uncertainty faded. No one needed to order the change. The reward structure made it inevitable. This rewiring happened gradually. Risk was not removed. It was redirected. Exposure migrated toward areas where incentives were strongest and oversight felt lightest. What paid well grew quickly. What paid slowly disappeared. The system evolved not through decision, but through preference. Markets reflected the shift. Capital flowed toward familiar patterns. Similar strategies crowded the same spaces. Success validated imitation. Innovation narrowed toward what fit incentive structures rather than what improved resilience. Diversity declined quietly. Regulators did not design this outcome, but they reinforced it. Metrics rewarded consistency. Compliance favored standardization. Institutions learned that behaving like peers reduced scrutiny. Difference became costly. Alignment became efficient. Early signals appeared subtly. Correlations increased. Liquidity concentrated. Reactions synchronized. Each change felt logical in isolation. Together, they reshaped how markets moved under stress. This is the opening truth. Incentives do not need to be dramatic to be powerful. They operate silently, shaping behavior day after day. And once markets adapt to them, reversing course becomes difficult. Because when incentives reward the same actions everywhere, markets do not need coordination to move together. They do it automatically. As incentives settled into place, they began shaping not just what participants did, but how they thought. Decision-making aligned with reward structures almost unconsciously. Strategies at work were repeated. Those that did not were abandoned. Over time, success became a template rather than an outcome. Institutions organized around these templates. Teams were structured to maximize rewarded behavior. Performance metrics reinforced conformity. Risk-taking focused on areas where upside was visible and downside felt limited. The system learned to optimize within incentive boundaries, rarely questioning where those boundaries came from. Markets amplified the effect. Capital chased the same signals. Trades clustered around similar timeframes, assets, and strategies. What looked like diversification at the firm level became concentration at the market level. Alignment increased without anyone intending it. Regulators observed orderly behavior. Volatility seemed manageable. Failures were rare. Oversight frameworks appeared effective. Incentives were invisible because outcomes looked stable. The system functioned smoothly until it was asked to function differently. Early distortions emerged quietly. Liquidity thinned in unexpected places. Price movements became sharper around shared incentives. Small changes in conditions triggered larger than expected reactions. Each signal was explainable, but none felt decisive. The deeper transformation was cultural. Participants stopped asking whether incentives made sense. They focused on executing within them. Behavior became predictable, repeatable, and efficient. The system lost flexibility without noticing. This is the hidden cost of incentive-driven markets. They do not create risk directly. They align behavior so tightly that when conditions change, everyone moves the same way at once. And when incentives reward speed, similarity, and scale, markets trade resilience for efficiency. Quietly, persistently, and without a single rule ever being broken. The conflict emerges when incentives that once produced stability begin amplifying stress. A shift in conditions occurs, small at first, but responses are immediate and uniform. Participants act rationally within the same reward structures, and those rational actions collide. Institutions adjust positions simultaneously. Exposures reduce where incentives change. Capital withdraws from the same areas at the same time. Liquidity evaporates not because fear spreads, but because incentives no longer reward staying. What worked yesterday stops working together. Markets react sharply. Price moves accelerate as aligned strategies unwind in unison. Volatility spikes without a single catalyst. The system behaves less like a collection of independent actors and more like a single organism responding to the same signal. Risk management struggles to slow the motion. Models assume diversification in their behavior. Incentives erased it. Losses remain within tolerance. Yet instability spreads faster than expected. What looked like resilience becomes sensitivity. Regulators face a familiar dilemma. Intervening risks distorting incentives further. Waiting risks allowing feedback loops to intensify. The system is not breaking rules. It is following them too well. Oversight built around compliance struggles with behavior shaped by reward. Public confidence weakens quietly. There is no obvious misconduct to blame. No single institution fails. Yet markets feel fragile. If everyone responds to incentives the same way, where does stability come from? This is the core conflict. Incentives are powerful because they feel neutral. But when they reward identical behavior, they synchronize reaction. Under stress, that synchronization turns ordinary adjustment into systemic movement. The system discovers that it did not lose control through excess risk, but through excess alignment. And alignment, once embedded in incentives, is difficult to unwind without disruption. Because when incentives change direction, markets do not turn gradually. They pivot together. The reckoning arrives when the system acknowledges that incentives shape outcomes more powerfully than intention. Markets did not malfunction. They behaved exactly as they were rewarded to behave. Stability was undermined not by disobedience, but by obedience to the wrong signals. In response, priorities begin to shift. Policymakers and institutions re-examine what behaviors are encouraged and which are merely tolerated. Incentive structures are adjusted to value durability alongside performance. Diversity of strategy is recognized as a stabilizing force, not an inefficiency. Institutions adapt unevenly. Some redesign compensation and metrics to discourage excessive alignment. Others introduce friction deliberately, slowing reactions to allow judgment. Risk management expands beyond exposure into incentive awareness. The system relearns how to value difference. Markets respond gradually. Capital disperses. Strategies diversify. Volatility becomes less synchronized, even if it remains present. Stability returns not through suppression, but through dispersion of behavior. For the public, trust rebuilds cautiously, not because markets promise perfect outcomes, but because they demonstrate learning from structural cause rather than surface symptom. Incentives become visible, discussed, and debated rather than assumed. Looking back, the quiet rewiring of markets through incentives reveals a lasting truth. Systems do not need bad actors to become fragile. They only need rewards that encourage everyone to act the same way at the same time. True resilience depends on incentives that tolerate inefficiency, delay, and disagreement, on rewarding behavior that does not always look optimal in isolation, but protects the whole. Because when incentives are invisible, their consequences are not. Subscribe to join the journey. How